Hey everyone, and welcome to The Explainer. Today, we are diving into a complete financial teardown of Avient Corporation. Now, if you follow the materials and polymer sector, you already know Avient is a massive player. But here's the thing. Surface-level stock prices, they almost never tell the whole story. To uncover this company's true financial health, we really have to look under the hood and systematically break down their most recent, highly detailed financial metrics. We're going to cut right through the noise, look at the hard data, and visually map out exactly what is going on inside this business.
Okay, let's look at our roadmap for today. We'll be covering 1. Avient's historical price performance, 2. Whether the stock is currently overvalued, 3. A safety check on their dividend, 4. Cash flow versus net income, 5. Efficiency and profit margins, and finally, 6. Our overall verdict on the Avient data. Let's get right into it.
Section 1. Avient's historical price performance. Before we can even begin to figure out where Avient is going, we really have to respect where it's been and how the market has historically valued it. I mean, just look at this massive number, 412.29%. That is Avient's 20-year return. It's absolutely crucial to establish this right out of the gate. For those long-term investors who got in 2 decades ago and just held on, Avient has been an absolute wealth-building engine. It really proves that the core business model has, over the macro long term, been highly successful at generating shareholder value. It's a true testament to the power of long-term compounding. But, when we zoom in on more recent history, the story definitely gets a little more complicated. There's a pretty sharp contrast here. The trailing 12-month, or TTM return, is sitting in the red, at negative 8.22%. It's been a really sluggish year overall. And yet, if we just look at the year-to-date return, the stock has bounced back with a positive 8.97%. So we have this historically long-term winner that's dragging through some recent volatility. It's down in the one-year view, but definitely showing some sparks of life in the short term. Which naturally leads us to the big question. What is actually going on with Avient? A stock price bouncing around like this is really just a symptom. To diagnose the underlying cause, we can't just stare at a stock chart. We have to take a trip down into the financial engine room. Let's look at the actual valuation.
Section 2. Is the stock overvalued?
All right, so we know the current price tag is around $33 a share, but as the saying goes, price is what you pay and value is what you get. The price to earnings, or PE ratio, is one of the standard ways to measure valuation, right? It tells you exactly how much you're paying for $1 of the company's earnings. Well, Avient's current PE ratio is sitting at 37.94. Now, context is everything here. When we compare this to their own 5-year average PE, it's currently over 44% higher. So, by historical standards for this specific company, investors are currently paying a pretty massive premium for the exact same dollar of earnings.
To truly grasp the risk we're looking at, we need to quickly talk about a key concept: margin of safety. Simply put, this is the difference between a stock's intrinsic fair value, which is what the underlying business is mathematically worth based on its cash flows, and its current market price. A positive margin means you're buying it on sale. And negative margin, well, that means you're overpaying. So the crucial point here is absolutely in the math. The last close price for Avient was $33.77, but the calculated fair value price based on their discounted cash flows sits much lower at just $23.31. And that gives us a severely negative margin of safety of nearly 45%. Basically, this data strongly suggests that the market has priced Avient way above its current intrinsic fundamental value.
Section 3. The dividend safety check. Now you might be wondering, if the stock is historically expensive, why on earth are so many retail investors still holding on to it? Well, because for a lot of folks, this stock is a pure income play. Right now, Avient is offering a very attractive 3.26% dividend yield. But listen, a high yield doesn't mean a thing if the company can't actually afford to keep paying it. So the million-dollar question is that 3.26% yield actually safe?
And wow, the data reveals 2 very different stories depending on how you choose to measure it. The traditional payout ratio, which is based on net income, is literally flashing a giant red warning sign at over 121%. They are paying out more in dividends than they are officially declaring in net profit. Usually, that is a fast track to a dividend cut. However, take a look at the free cash flow payout ratio. This measures the dividend against the cold, hard cash actually entering the business. And that sits at a very healthy, incredibly safe 51.20%. And honestly, that safe cash flow coverage is exactly what has allowed Avient to achieve this remarkable milestone. 16! That's 16 consecutive years of dividend increases. Even through some really tough economic periods, they've managed to consistently raise their payout, which is a massive green flag for anyone trying to build an income portfolio. But we're still left with this glaring contradiction, right?
Section 4. Cash flow versus net income. Because how can a company have a terrifyingly high net income payout ratio, but a completely safe free cash flow payout ratio? Well, this brilliantly illustrates the answer. Just look at this massive divergence in their trailing 12-month growth rates. Net income has completely crashed. It's down nearly 52%. Earnings per share is down almost 65%. On paper, those profits look terrible. But free cash flow, it has surged over 44%. Basically, non-cash accounting charges are severely depressing their official net income, but the actual real-world cash-generating power of the business is thriving. And this right here is exactly why looking at just one metric is so dangerous.
Section 5. Efficiency and profit margins.
Now, we can't let management entirely off the hook just because the cash flow is strong. We still need to measure how effectively they are running the core business. Return on invested capital, or ROIC, shows us exactly this. It measures how effectively management turns their capital into actual profit. And notice how these stairs are stepping firmly downward. The 5-year average was a totally respectable 6.73%. Then the 3-year average dropped to 5.71%. And the current ROIC? It has slid all the way down to 4.34%. Avient is just becoming less and less efficient at deploying its capital over time.
And we see a very similar story when we look at the net profit margin. The 3-year average sits at 7.84%, but over the trailing 12 months, that margin has literally been cut by more than half, dropping down to just 3.59%. So while they are definitely generating strong free cash flow, the actual efficiency of their operations, their ability to wring a real profit out of their revenues, is currently suffering a pretty severe historical dip.
Section 6. Final verdict on Avient data. So we've seen a legendary 20-year run, crashing earnings but surging cash flows. Let's pull it all together. Here is your all-in-one scorecard. On the bull side, the positives are incredibly clear if you're an income seeker. 16 straight years of dividend growth, supported by a rock-solid 51.2% free cash flow payout ratio and a very strong free cash flow yield of 6.3%. The cash engine is absolutely humming. But the bear case is equally compelling. The stock is currently incredibly expensive with a negative 44.88% margin of safety, net income is plummeted, and their core efficiency, measured by that dropping ROIC, is taking a sharp hit. Which brings us to the ultimate question you have to ask yourself, based on all this data. Is the safety and consistency of that dividend really worth paying such a massive premium price for a company that's currently struggling with its profit margins? The cash is certainly there, but the efficiency is not. That is the tightrope Avient is walking right now, and understanding this level of data is what empowers you to make truly informed decisions. Thanks so much for joining me on this explainer, and keep learning.